Morning, all. Yeah. Um, First of all, we should salute all our Jawans who are protecting us so that we can sit in this air-conditioned hall and discuss about the topic. Coming to the topic, this is a very old topic, so I'm not going to explain to you anything which is different than what is there. And what is being there in the standard is 15 years old. And all of you are senior, all of you are well, uh, uh, all of you are learned, correct. So I'm not sure with what I can, give it to you. So the purpose of this, my presentation is to share experience, and I would encourage all of you to share the experience. I understand you are planning or you are registered as a peer reviewer or planning to get empanel with peer reviewer. So if you are registered, then please share your experience. If you are planning, then also share your experience. How, while doing the audit, what has been your challenges and how you address them. Because peer reviewer plays a very important role. It's not it's I say the way, the time, and the peer reviewer, it's like giving back to society. uh, because if it is done right, it is expected as a profession something has been right. But if it is something done wrong, and somebody else were to come and review the files, and if it is found out, not only your personal reputation, but it is the reputation of the institute and the institute's processes which are at stake. And I'm sure Nolaka ji has explained the nitty gritties of, and he is so detailing, he is so entertaining, and he shares his experience in such a lucid manner. So it's easy for one to understand um, what are the expectations and how those forms needs to be filled. What are the practical challenges which is there? Discussions are always very engaging. I've heard him, and I'll also try to live up to your because it is pre lunch session, and I'll also try to see that I don't eat into your lunchtime. So there are two topics which has been assigned to me, and as I said, I'll try to cover it. There is nothing new, nothing different. Some practical things which I'll try to explain. So this is the agenda. For first is what are the technical and professional standards. Technical and professional standards everybody understands. I'm saying let's get into going is accounting standards, auditing standards, guidance notes, right? Schedule 3. So this is what is the first topic is on accounting and professional standards. So these are the standards. What are the applicable laws? Important statements institutes issued by the institute, code of ethics, publications, even NAFRA standards, their guidance. One has to keep in mind while doing the audit if it is a NAFRA. Uh, the next is what are the frameworks, because there are different frameworks. When you go and review, there are different frameworks under which the firm would have done the audit. So it could be Indian GAAP, it could be Ind AS, it could be IFRS, it could be US GAAP, it could be any other GAAP, because if the company is a component of a foreign parent, and the foreign auditor, parent company auditor wants the firm to give some reporting, then it could be any other gap. And that is all. These are the framework. There are two kinds of and this is something which I can we can do it, is because one is true and fair. True and fair is we are very used to, we give true and fair opinion. What is a compliance framework? And that is where one has to be careful what kind of reporting is being done. So if, for example, audit is done for tax purposes. It is a compliance framework. It is not true and fair. True and fair is as per the uh, accounting standard or some framework with all the disclosures or with condensed if it is something condensed. Lot of times it's not the compliance as a true and fair it's not true and fair opinion, it's a compliance, so it is compliance with the of the of the parent, or we give only reporting pack. You know, lot of times multinational companies, they have a reporting pack, and one auditor needs to fill up all the numbers and give those explanation within the reporting pack. So it's not a complete set of financial statements, and hence it's a compliance true and fair framework. I think that one care needs to be taken to ensure it's a right framework under which the opinion is issued. Coming to what is audit, I think if we go back to this, I'm little going back to basic to go back to the, the practical challenges. So what is our objective as auditor? The objective is to obtain a reasonable assurance that financial statements as a whole is free from material misstatements. Ultimately, the word material is important, and we'll deal with it over the session, whether due to fraud or error. So it's a reasonable assurance that financial statements taken as a whole is free from material misstatement. And how do we do it? The auditing standards gives us the guidance as what is the objective of this, how it needs to be done, how one plans it, how one executes it, how one documents it, how one reports. So that is the auditing standard. And as I said, none of the standards are recent. All these standards are 15 years at least old, 15, 20 years. What it requires, I think this is a very common and topic, is what it requires. It requires us as an auditor to exercise professional judgment. What is this? Is auditors? This is professional judgment, and that also we'll discuss over the my talk. And maintain professional skepticism, because if you see all the NAFRA orders, the judgment is the one which gets challenged, and whether the auditor has exercised professional skepticism. And both these are important because that is the domain of the auditor, but the skepticism needs to be demonstrated by virtue of the virtue of the documentation. So as auditor, what do we do is identify the risk of material misstatement, obtain sufficient appropriate evidence. Sufficient is quantity, appropriate is appropriate under the circumstances. We'll deal with it. I just want to create this groundwork when we go to the next topic. Is sufficient and appropriate, and then form the opinion on the financial statements. This is the objective in a nutshell. I thought, this is my favorite slide. I would have taken this slide in several of my presentations on auditing standards. Is how to explain the objective. First is understanding the entity. So the peer, so the when you look at it, I'm not getting into, I'm considering all of us as an auditor, but whether you as a peer reviewer are reviewing, or you as an running a practice, you are doing it, whether all this is documented. So understanding the entity. What does it mean? What is the environment? Environment means, is it listed? The environment becomes, is it regulated? Right? So if a listed company, those compliances. More regulated, so banks, NBFC, insurance, telecom, correct. Are they regulated? That is something. Is it leveraged? The environment changes, right? If it is leverage. So understand under what environment the company is operating, because that has impact on the auditing procedure. Ultimately, we have to do do actually the execution. Lot of time goes into understanding and planning. And hence, it is important that how that understanding has been obtained and how what is the evidence that this understanding has been obtained. So first is the understand the environment. Now, if there is an environment in which the company is operating, the company would have some controls that is also there in auditing standard, right? What is the control environment? You go to a company, you realize now what is the control environment in the company. That's a feel, right? How the company does the risk assessment. We have not started the audit, we are understanding. And that is how documented. And whatever I'm saying is it has to be documented somewhere. What are the control activities? How is the information system? How the company is monitoring that, all this, what the company has set. There are, five components of internal audit. If you, it's a pure understanding which needs to be, documented is these are how the company's control environment company is operating in this. After understanding the environment and the control, identifying the risk of material mistake. I'll give you the example also, but I'm saying this is how the process starts. Whether it is due to fraud is intentional or error. It is not intentional. Identify what are the areas. But we don't get into the all over the business. We don't understand the company's business more than the companies. They are running. We are only at the financial statement. So then financial statements level. We understand all this, but then we start getting deeper into it. Saying financial statement level and the assertion level. I'll give you the examples of that. Understand, then design and implement. This is how the actual execution starts. Design and implement response to assess risks. And the idea is to reduce the risk to the minimal. As an audit, we do on a sampling basis. It's not possible to 100%. Correct. So we'll leave it to the expected acceptable level based on which we form an opinion. This is a very nutshell of how the audit needs to be done. And these are some key standards. I'm not getting into it. Lot of this discussion is happening around audit documentation. So out of few standards, key standards, these are the few ones which I thought we can discuss based on what is happening in and around, what is the regulatory concern, how regulators are, giving their, observations and report to, mainly NAFRA. So idea is that documentation is one area where we as chartered accountants are. So I always say we are, uh, we burn midnight oil. If client has any accounting issues, so we roll up the sleeve. A solution क्या है, इसको क्या करे, इसको क्या करे, but we don't document. We may spend, sleepless nights to give solution, provide solutions, but why we did, what we did, that is not documented. And somebody comes and reviews the file, there is a lack of documentation, and that's where. So we as auditors do over audit, but when the regulators come and review, it appears as under audit, and hence there has to be a balance between accounting challenges and documenting the what is expected from auditing standard, because somebody who comes will review the file. And what is expected is, so one is the experienced auditor, and I'll explain what is experienced auditor later. Somebody, so experienced auditor having no previous connection with the audit. Correct. Understand. There is no connection with the audit, but that person is experienced. Can understand the planned audit procedure. How you planned. We went through the objective. So how that planning has been done. What is the nature, extent, and timing, which is most important. Nature of auditing procedure. What did you do? Why you did this? extent, volume, timing, at what point of time in the course of audit that has been done. What was the result? What was the evidence obtained? What was the result? What was the significant issues which was identified? And what was the conclusion? And judgment. Remember that one thing, judgments made in reaching those conclusions. So this is what an experience, somebody who's not connected with the audit. But hey, that person is experienced. Very important is experience. He understands the auditing, the way it is being done. But it is very, clear. It is something is not documented. That means it is not done. Nobody can go back. That person changes, team changes, right? Partner changes. The file should speak for itself. So it's a legal document. No more it's, you know, auditors are accountant. They are also lawyers. How somebody else will interpret that document based on which the conclusion is done. So that is something, that is the level, because if you look at all the NAFRA reports, their comments and their observations, it's all legal. If it is not documented, and I'll tell you how deep they are going. Some examples I've got. But important is the experienced auditor who is experienced, so not somebody who is just qualified 1 year, 2 years. An individual who has practical audit experience and a reasonable understanding. And this is where, it is important that somebody is experienced. He understands the audit process. He or she understands what is standards of audit and what are the applicable legal and regulatory requirements, the business environment, and auditing and financial reporting issues relevant. So somebody who can audit this, somebody who is experienced, it's not for somebody who does not understand auditing. It is somebody who has gone through the audit, somebody who has been experienced as auditor, somebody who understands that industry, somebody who understands what is the reporting requirement, somebody understands the challenges, because it's not true and correct. What gets interpreted is true and correct. Actually, it's true and fair. It's an opinion. But how it is being done, it's not a legal audit. It's not a forensic which is being done. We are giving a reasonable opinion, and hence the word experienced auditor is very, very important. Why I'm, gave you this background as how it is being reviewed by NAFRA. I've quoted some of the lines from NAFRA, right? Let me make the declaration that I the this file, the partner who has done this is my former colleague. I've retired from the firm. Is a very competent, and I've learned a lot from him. And I rely on what is there. But how NAFRA is interpreted, I'm just trying to bring two things together, and I'm confident that whatever he has done would be detailing. But I'm just trying to bring that how when the file reviews and when you do go as a peer reviewer, how one should look at it, because that is the expectation of NAFRA. If you go and say that this firm has the best of the rating, and NAFRA were to come and pick up the one of the NAFRA files and find some errors, what will be your reputation and what will be the reputation of the institute when the institute has also put up that rating in the website of the firm which you have peer review. So I'm just reading few of the observations. 11 instances of mismatch between VP is a work paper, TP is a team planning event. The importance of team planning event. March 2018, soft copy. So there is something in the soft copy and there is something which is a hard copy, which is, when you do, something is in the file, something is there, and some error is there, you rectify that error. But in the hard copy, by mistake, some error is not rectified. So that means that's a comment. How, anytime some meeting is there, you put it in the prints are taken out. One print is there in the hard copy. Some error was there, so that error got rectified. Somebody filed the file, missed. It is not expected to be there, but the file was hard copy was there, and hence this error has been identified. The lack of evidence of any analysis carried out by the audit firm and no accompanying evidence to support management assumption of going concern. Now this is a reporting requirement, so lot of work would have happened. But earlier, before the reporting requirement, it's you understand what is there, and based on that, you come to conclusion. One does not start getting into it why this is a going concern, unless there are evidence that this cannot be going concern. Then these minutes did not include discussion of any fraud risk. It is expected. What is the discussion? This is a audit has not started. We are at this entity level, understanding the control, right? We have not started the audit. Fraud risk. While fraud consideration, this form dismisses fraud risk even without assessing presumed fraud risk. So what is the fraud risk? Ultimately, risk of material misstatement, fraud risk. This is very aligned, right? So each and every audit file which you review, what is the fraud risk? And there is a presumed fraud risk. Revenue is a presumed fraud risk. One and this is it is rebuttable. So one can document that since this is a presumed fraud risk, but why as an auditor I do not consider this as a fraud risk. So identification, even if it is not no fraud risk, as a it's a professional judgment. Document why it is there. So this is what is there. The NAFRA observed that audit strategy memorandum contains staggering conclusion not supported by evidence of substantive work done. Whatever is mentioned, what is the evidence? Ultimately, what is coming out, it's evidence. Whatever is conclusion is there, don't even speak. Whatever is there in your mind, document. And what is the evidence of that document? Then it says, work paper mentions engagement partner updated the team about the business risk, significant risk. However, neither documentation on such explanation of the background and functioning of entity sector, understanding the entity. Remember, I was telling what is the understanding of the entity when you identify the risk? Where is it documented? Nor any discussion about major risk and auditor's audit procedure. What is the work has been done? This is what is expected. Why I mentioned that small chart, just trying to connect it with what is NAFRA's observation. Understanding the entity is important, right? How you have identified what are the risks, what are the risk of material misstatement, identify. Fraud risk, identify. If no fraud risk, document why no fraud risk. What is the basis of all this? Document. Audit has not started yet. It's only the understanding piece. Then management representation note referred to by the audit firm is neither addressed to the auditor nor dated. Again, legal. Sometimes, this letter, something comes when the mail comes. There is attachment to the mail. One forgets to do this. And such management representation is not acceptable. So management representation duly signed, everything, it has to be, it's a legal document. Don't get into it. NAFRA has observed a reversal of ECL is not supported by evidence. Everywhere it is evidence, documentation in the audit file. In respect of loans, there was no evidence of sample verified containing proper loan schedule and all this. Again, evidence. What you do, evidence. What you do, what you think, what you have done, evidence. Why you thought this, why you did this. The document tripartite agreement dated 31st March, whereas in the audit firm's response, it is stated 29th March. Any error, fraud error, what I'm saying, this is error. But if it is any, two mismatch, that means it cannot be accepted. So it's all legal. There was no working papers in the audit file to explain the reason for change in the estimated cost for the project, nor had auditor documented the revised agreement in support of change of scope. And understanding the business, sector, business, what has been done. So I'm saying 15, 20 years old standard. We've been doing audit in one way. Now it is being done, reviewed by NAFRA. So it's all legal. And please be mindful that whether the file which you are reviewing as a peer reviewer, uh, is it speaking for itself? And what is the expectation of NAFRA and all? Nowadays, they've also gone saying that if you're qualified, then why not put disclaimer and all? What is normally the expectation is it, if there is a problem, please bark. Correct. So it says now we have always been said that we are not a watchdog or a bloodhound. What is the expectation now is the bark. What NAFRA's expectation is, have you barked rightly at the correct tone? So by, earlier we would say at least we have brought it in the audit report. So EOM, then somebody will say, okay, I've qualified this. NAFRA is going step further is, have you rightly qualified? Should I have said I disclaim it or it does not show true and fair? So even the right way of, base, and it's all judgment, right? So what is the basis on which what you are doing, or the firm your peer reviewing or the report, is it in the right tone? Is it documented? The judgment. So again, the judgment comes into play. What is the basis on which this conclusion is? The level of documentation is size, and so not all audits will get into similar level of documentation. So size and complexity is very important. Most important is the what is the risk of material misstatement. What are the areas? So not all areas one will document in the same detailing. Correct. That will come back into the nature extent, and I'll explain that in the next one. But what is the risk of material misstatement? That is the focus. Nature, timing, and extent. Most important, we do all the things all the time. I'll explain to you in a separate this. So I'll now. Significance. The significance of audit evidence, level of documentation depends on this. If it is a large litigation, we have taken the opinion, that opinion is important. Whether the opinion should be in the name of the audit firm, it's because as a firm, somebody is giving you opinion, right? Third party opinion. Figure out what is the significance of this. If it is say valuation, how have you, there is large intangible, some valuations. So depending on the significance, how many, exceptions noted, methodology. So I think I don't have much time around this. Now let me come to risk of material misstatement. So we've been talking, and how do we get into the risk? What is the risk, and how do we look at the risk? So audit risk has primarily two things. One is something which is inherent in the risk. So anything. So for example, say company has liberal bonuses for say sales. Sales becomes inherent risk because somebody will try to, you know, increase the sales because of the incentives, or somebody gives liberal. Debtors will also be important then, right? Depending on, you'll have to figure out if somebody company is dealing in cash, lot of things, say retail operations, then cash becomes inherent risk. Cash itself is a risk, but some more handling of cash, that means inherently the risk of that account is high. Idea is that what is the inherent risk? Inherent risk of that account. So one has to look at each and every account and say what is the inherent risk of this account, assuming there are no controls. Assuming there are no controls, then what is the risk? So it's called inherent risk. One is the inherent risk, assuming there is no so each company will have a different way. So for example, inventory could be inherent risk if one has to use experts. Inventory is high value, non-moving. Inherently those are high risk. The second is, how does the company? So company would have had some control around this, that high risk items. So what are the control risks? Understand that control risk. It's a combination of these two is the one which determines the risk of material misstatement. And the third is the detection risk, that as auditor, while auditing, as auditor we miss. But that for calculation I am not taking, but I'm saying this is the audit risk universe. Inherent risk, which is without control. Then there is a control. Combination of these two is the risk of material misstatement and the detection risk. This is a bit busy slide, but let me explain, why I so this axis is inherent risk, right? It could be low or high. And this is inherent without control, and this is a control risk. Control risk, when there is a management is instituted control, then one decides whether to rely on the control or not to rely on the control. And I'll go down to the example to drive home. So one is uh, the last is the significant risk. Something has happened. Client has changed the ERP system. So the IT, correct. So whether the accounting system impacting the IT, is it, or there is a large acquisition done. So then those items could become valuation becomes in days valuation becomes important. So there are special concerns. So these are significant risks. So combination of these two, how it is analyzed. Let us go step by step deeper into it. So I'm gone into the account, say inventory, right? I'm saying inventory risk is, first of all, let's go look at cash and cash equivalent. Say I'm inherent risk is high, right? So I'm dealing lot client is dealing lot in cash. Then you will say, what is the control client has? You'll say, I can rely on the control. If that is there, what is the risk of material misstatement? Low. Correct. Control risk, inherent risk, low. So inherent risk is, this is important. Next is the same thing. I've just tweaked the example. Saying inherent risk is high. I can rely on the control. But still the conclusion can be risk of material misstatement is high. Reason? Reason is because either I feel inventory, it's you high, I have to rely on the expert. Say if I'm doing inventory of say jeweler, what is the purity? Right, important. It's a high value item. I'll rely on the expert, or some large work in progress. So I'm saying depending on the account and the client, I'm saying I've given a different example. That means it's a significant risk. If significant, hence earlier and now, inherent risk was low, I can rely on the control. But as an auditor, the judgment, the risk of material misstatement is high. So I'll classify this account as high. One has to go account by account to evaluate what is the inherent risk, what is the control risk, and what is the risk of material misstatement. Why this is important? And one of the thing which is always there is nature, extent, and timing of auditing procedure. My nature of auditing procedure will be more persuasive if the risk of if the control risk of material misstatement is high. but my nature of auditing procedure will be less persuasive if it is minimal. I given the two extreme. In between it could be low and moderate. The idea is that how this has been analyzed to come to conclusion that what is the risk of material misstatement. The idea is that not all account needs all high kind of procedures. Some accounts has less risk, so lesser procedures are can be done. Focus should be on the risk of material misstatement. That is, now here we have gone at the account level, but when we actually say that this inventory is, as a part of I am confirming this inventory in the financial statements. What do I say? What do I mean as an auditor? So there are five assertions. Now one has to do this risk of material misstatement on five assertions. I'm not telling you anything which is different. This is all in audit. But idea is that how do we focus on risk of material misstatement, focus our energy on those other items. Existence. When P&L or balance sheet items, one is look at existence. Is the asset as exist or not? Right? If inventory, if there is a risk of existence, whether in jewelry purity is there or not, that item is there or not, quantity is there or not, volumetric, if you are doing that volume appropriate or not, existence is the one which one is looking at. Rights and obligation, whether it belongs to the company or the obligation is there, whether everything is complete, and the valuation. Figure out, and the last is presentation and disclosure. Figure out in all this which are the assertion when there is a risk of material misstatement. That is the area where not all, saying not all the assertion one is to work, uh, consider this as this the as um, uh, law, all the more persuasive procedure. Figure out which assertion and whether what is, and this needs to be documented. When somebody comes, when you go and review the file, when somebody does, please evaluate where is the risk, because somebody would have done the risk of material on inventory, on valuation, whereas the existence is the risk. Evaluate where is the risk of material misstatement. So they, lot of work would have been done on completeness and obligation, but existence, there is no work done. But the existence is the one where there is a risk of material misstatement. How does it come? One come to know? Understanding the industry, understanding the environment, understanding the control, and then evaluate. So idea is that how from top to identifying what is to be done is the one which is expected. And similarly, it is for P&L items. So P&L items are also five assertions, right? Occurrence, whether the sale has occurred or not, completeness, classification, sales, other income, other operating income, measurement, how sales are classified, POCM है तो what करेगा, क्या करेगा, cut off, very important. And sales is a presumed fraud risk unless it is documented why sale is not considered. It's a it's a biggest item in the financial statement. It has to be documented because all the stakeholder looks at what is the sale. Anything on this? Then I will go to some other theory. Again, we'll come back. Anybody wants to share any experience? I'm saying, I'm not telling you anything which is out of syllabus. I'm saying how does the practically, how does it, you know, get implemented? Now, fraud risk assessment. Seen that NAFRA comments, now fraud risk assessment, how it is done. So it's not something, again, understanding the industry, understanding the sector, we saw NAFRA comments. So fraud and error, whether intentional, we said, skepticism, very important. And again, lot of times the comment is, the evidence is there in the file, but work has been done. One can't take straight that document in the file unless the one does some work on that document to come to conclusion. So plain and simple is, as auditor, we go by the evidence. That is the skepticism. Client अच्छा है, वो जो last time बोला वो किया, we trust them. We of course we trust them. That's why they are our clients. But this year again to do, what is the evidence? So nothing futuristic. We go by the evidence. We audit the history. It has to be evidence backed. We trust the client. Otherwise, it's this is not something. So that's exactly the this skepticism. So whatever we do, it's not that we do, but we say what can go wrong in this. So it's not, and that's the thin line one has to draw, is we are not trusting the client, but it's a skepticism which we are demonstrating. um, Earlier it was very sensitive to ask clients, आपके उधर कुछ fraud हुआ है क्या, कुछ inquiry है, कुछ ये है. Now it's very accepted, last 5 years, 5-10 years, it's very accepted one asks those difficult questions, any fraud which has happened, right? Audit committee one normally in a very regular course asks that either we are aware of this fraud or we are not aware of any fraud. As audit committee members, are you aware of any fraud which has happened? We are not aware. It's a very normal thing for auditors to ask. I remember 10 years back would have been difficult. uh, Revenue, I've said, journal entries, everything is fine, everything comes through the system. Who passes those journal entries? Because those one entry here and there could change the face of this. Accounting estimates, all the orders will say what is the work which has been done on estimates, what are the key estimates, what is the basis. We'll take some few of them, significant transactions in, correct. Now I've got 45 minutes. I'll try to cover more of examples. Otherwise, I said there are one more topic which is SQC1, which I'll run it fast. So I'm just trying to balance it. Unless you have another preference, because 45 minutes I'll not be cover everything in one day. So first we saw risk of material misstatement. Now, how do we determine materiality? That becomes another question, right? So what is materiality as from the standard? So misstatements including omissions are considered to be material if they individually or in aggregate could influence the, the economic decision of the user taken on the basis. So it's very important, economic decision of the users taken on the basis of the financial statements. So it is decision based on the financial statements as a whole. So if we say that inventory is so and so, inventory is not true and fair. It is taken on based on the financial statements, inventory is true and fair, because we do work based on the materiality determined based on the financial statements, not at the account level. Judgment about materiality is affected by the size, number, or the nature, and we'll deal with both, or the combination of both. Auditor's determination of materiality is a matter of professional judgment and is affected by auditor's perception. So this is a professional judgment, that we saw what is the objective. um, when we say about the users, and this is something, it's not for somebody common, it, economic decision of users of the financial statement. So who are the users? And that is where it is, explained in the standard, is who are the users. So it's not somebody who is a common who does not understand financial statements. And we say, okay, he believes that this is material and hence this is material. So it says material, the auditor may assume that users have reasonable knowledge of, of business and economic activities and accounting. have willingness to study financial statements with reasonable diligence, understands that financial statements are prepared, presented, and audited at the levels of material. So a lot of times, you know, we get those side comments ना कि उसने ये नहीं किया, उसके financials में ये problem है, ये problem है. Auditors do it based on materiality. Materiality is based on somebody who understands the financial statement, somebody who understands the reporting requirement. It's not a hindsight. Lot of times what we say is it's a hindsight that one applies. It's not a hindsight. The audit is done in that point of time. It's not done after a year what has happened to that company. Recognizes inherent limitations in accounting estimates, judgments, and consideration of future events, and makes reasonable economic decisions based on information in the financial. So this is the what is the universe. It's not everybody. Somebody who understands the financial statements. Documentation is somebody who understands the audit, somebody who understands the reporting requirements, somebody who has been the auditor. And why do we use this materiality in planning the audit? How do we plan? We'll take some example. Performing the audit, planning the audit, performing. If we get during the course of audit, if there are an identified misstatement, if there is some misstatement, how do we deal with it? Right? And if there is something which is not corrected, then how do we deal with it? So materiality is the basis on which our so it's an overall guiding principle as to we do work based on the material, and materiality is uh, uh, not static. It will evolve, and got one couple of examples on this. So example is say, for example, profit before tax is say 10 crore, total revenue is 100 crore, and total assets are 300 crore. The example is very standard. I thought one example as to how do we calculate material. Normally, just think about it. When you look at any financial statement, what you look at? One is turnover, the other is profit. Profit is very important in the normal stable companies, and hence by by and large, it's a profit number which is looked at, and then based on the profit number, evaluate in a as I said, stable businesses. Look at. So I'm saying auditor may calculate materiality at 5% of profit before tax. I'm saying it is a judgment. One can say higher, one can say lower. Device, it's a reasonable 5% is acceptable materiality level which can say. What materiality to use is auditor's judgment. Again, here also it's auditor's judgment. It could be on various other factors, and this is something which is I've explained in the further slides. So one is the materiality, but this is the materiality at the financial statements level. But one doesn't work at the financial statements level because one works at an account level. And hence at the account level, the materiality has to be lower because financial statements we give opinion of all the accounts together. So here we have to bring down that materiality at the financial statements to account level. And that account level materiality is something which is called a performance. At that level, we will work. Again, auditor's judgment. And the third number is hence we'll ignore and we document that this is my materiality at the financial statements level. This is my account materiality at the account level. And number below this, I will not even look into it. I'll ignore because focus is on the risk of material mistake. Again, a bit busy slide, but I'll. So this is the first one is on the earning based. So if there are earning based company, it could be on pre-tax income. It could be on look at what the users, economic users, they are looking at. It could be on normalized earning. It could be on EBIT. It could be on EBITDA. It could be on gross margin. It could be anything because it is earning based. and it is a stable company, you look at and look at, all the analysts who analyze this, they will analyze on one of the, parameters. As auditor's choice, one can look at it. It could also be activity based. So if there are revenue but companies into losses or near break even if it is near break even, that means we don't audit at that level. A lot of, so ideas that look at it in some other base. So it could be say revenue, it could be operating expenses, or it could be capital based, say infra company and all. So it could be an equity asset. Evaluate the materiality based on any of the parameters. Document why it is being done on this basis. That is how the materiality starts. And one example, just see how one can look at it. So in a normal company, so if profit before tax is say 100, insurance claim received due to flood 5, and loss on sale of subsidiary 100. So in profit before tax is 100, but included in this is 5 and 10 of this. Auditor's judgment whether to do it on the normalized earning or based on pure PBT. Because one knows why this one-off items are there. So those one-off items can be eliminated. It's a normalized earning based on which the materiality could be calculated. It is auditor's choice, but the idea is that normally one-off items are not considered. This example I've done it a few examples just to drive home the materiality. Uh, See, COVID happened in mid March, and a lot of companies were profitable till January or February, and suddenly last 15 days what happened, and they significantly uh, profits came down, and they went into losses. Now, as auditor would have started doing the audit much before that, but the opinion was given in say May, June, whatever the time got extended, and the idea was, should we relook at the materiality with what happened in COVID? Because it's so COVID was one of technically, but how do you say this is the impact of COVID? Like I'm saying, profit on sale of subsidiary or insurance claim received. There is no effect on. It's a normal course, right? Achha, users look at the financial statements based on the year number. Number is lower, the materiality will have to be changed. I'm not, normally I would have given discussion would have happened because we don't have time. I'm running fast. So it has to be done based on the profit which one is signing off, based on the parameter or the measurement based on which the auditor is signed off. Auditor then can't say that this happened later, I started work doing earlier, and hence I will not consider this. This is the point which I wanted to drive home in this. We are signing, whenever we sign off, the events to balance sheet date taken into consideration. This has happened during the year. This was a classic case, and I remember, a lot of work which had to be done to come to conclusion that my materiality, what additional work is required, and how that has been done. The next is the auditor of a company identified misstatement during the audit of related party transaction, which is the below materiality level determined. So how do we one deal with it? Should we say ignore because it is below my materiality level? So that is where the issue is. Materiality is not a number only; it is a nature and the type of material. Now, if one gets the error in the material related party transaction, it's a very fundamental. Now one has to look at it: what is overlook, what is deliberate. So This is not something which can be ignored. So nature of error should also be looked at, not only the absolute number. That is why this. The next is, a lot of times company sells through various distributors, and then one does not pick up everything. But when the audit is being done, few of the distributors, and what the company auditor of the company realized that there was error in discount allowed to few customers, which is not material. Remember, ultimately we say we work at the materiality, we work at the account level, financial statements level. But how do we then look at materiality in a different aspects of it, and what nature of? So if you find some errors in few customers, we don't audit 100%. So then it says that it has to be extrapolated, that error, and say that if I found materiality on, say, so many sales, so much error, then I did so much sales on all the distributors or all the customers, then this is the likely materiality. Record that number. If it is above materiality, deal with it accordingly. If it is below materiality, deal with it accordingly. But at least that working. So it's not that based on sampling we did and we do ignore what is happening beyond that sales, or beyond that on that population. That is why this example. Correct. Yeah, then it's a judgment call. What I'm saying is it's not a sacrosanct. The purpose of this is that one is the nature and the type. Correct. But it is not sacrosanct. That is the. Now this is another one which says that in the auditor identified no misstatements. All this. This is probably one of my practical. When in the second year, the audit difference contain small errors related to processing of routine transactions. They were corrected by the entity, and they occurred because change in IT system during the. In the third year, management has resolved this problem and does not expect to encounter similar level of misstatement. Can auditor set higher limit in the third year in which is about to begin? Correct. Management बोला last time देखा था हम लोग ने कर लिया सर. Here the issue of professional skepticism comes into play. Management बोला है we trust, first do this evidence. Once as auditor we come to conclusion that okay, we are comfortable, then accordingly you determine. As I said, if you find the errors are there, materiality will become low. Nature, extent, timing. Correct. The extent of auditing procedure will be more if chance of risk of material misstatements are high. So nature is repeating nature is more persuasive if it is high, less persuasive it is low. Extent is number of samples are more. I do audit more of that number. If risk is less, I'll do less. Timing is, if it is high risk, then I'll do closer to the year end. Stock verification, I'll do closer to the year end. Right? Anything which is risk, I'll look at, evaluate closer to the year end. If it is less risky, I can do it in between. I don't need to look at equity share capital. I'll just move forward, ensure that company has not issued any further shares. But company regularly issues ESOP, regularly ESOPs are exercised, that become account becomes, I'll look at till 31st March what happened. I'm saying try to nature, extent and timing it depends on the risk of material misstatement, low, medium, high, and accordingly the auditing procedure will undergo. Okay, now how do we evaluate what is the risk? I think this let me pass this. Then what are the other documents which is there? So I don't think the presentation will be available. So I think let me see if there are anything which, yeah, one thing is uh, confirmation procedures. It has to be direct, correct. Digital confirmations are allowed, but what you get confirmations because the customer or the other party is on Gmail, Hotmail. There's the domain name is not there. Be extra careful. Do additional procedures around this because Gmail, Hotmail account anybody can open. Right? I think it is there in SQC, but this is important. Couple of areas which is the focus of NAFRA and which is there is one is EQCR. What is the involvement of two, three things I want to mention here. What is the involvement of the partner? What is the involvement of EQCR? And work done in and around consultation. These are the three areas which is very favorite if you look at the observation. So one is the involvement of the partner. Partner responsibility is planning, supervising, executing, reporting. Partner is should be all pervasive. And how do one demonstrate partner ka time hai? Partner is spent enough time. Time sheet. Everything gets linked. It's all digital. When was the planning done? How much time? How what is the evidence of review? Uh, when was EQCR involved? If you are EQCR in any of the account, most of the time you get to only sign the documents. But look at the NAFRA reports. That uh, we are responsible. Involvement comes right from the independence to planning to risk of material misstatement, issues identified, reporting, by reading financial statements, and all pervasive how involvement, sign off, partner, those timing on the timesheet that also needs to be aligned. So that is partner time, EQCR time. And the third one, which is on consultation. What are the areas on which consultation was done? What was referred? Because a lot of time consultation is done because we want some kind of opinion. So whether all the facts have been given, what was the view of the expert, whether internal or external? What is the opinion? How it has been addressed? Ultimately, it's the auditor's view and opinion, but how it has been addressed. So the idea is that these three, four items, because auditor is not somebody who understands, so it takes help of other experts. And how taking help of other experts that has been considered in overall, um, uh, you know, planning, executing, reviewing, concluding, reporting on on the audit opinion. Going concern is there. Secretarial documents, anything which is in the file, one has to find a reason. A lot of times, you know, it's only the minutes which is there. The whole minutes of is there, but what is the impact on the financial statements is not there. So just putting the minutes is not sufficient. How it has been addressed, those discussion in the is important. Claims and litigation. Um, Important from the point of view is because those claims and litigation, it's we have access to the books of accounts, but what happens outside, where are the claims came in, what is the litigation, that is outside us, so we have to rely on the management. And that is something because it is possible that somebody may uh, not disclose some litigation, whether uh, knowingly or unknowingly, and hence that taking that representation every quarterly is important. I'm not saying yearly, every quarterly that, okay, what are the my list of litigations? Is there any update? Estimates, it's a discussion by itself, but as I said, ultimately in long run, everybody's dead. Everything is cash to cash. But unfortunately, we have those quarterly, half yearly, yearly, and hence all those estimates are to be. So, what are the key estimates? And how, on what basis the auditor has come to conclusion these audit estimates are, uh, reasonable. SQC1 will deal with it. Significant issues identified and how those are addressed. Management letter. I've seen a lot of times the management letter is not obtained. Then, if it is not obtained, the auditors take unlimited responsibility. So the practice should be that management recommendation letter is discussed upfront, means before signing the financial statements, and it is it is with the auditor before auditor signs the financial statements. Nowadays, sorry, yes, anything, or you sign certificate also, forget limited. Even you sign a certificate, you have to take MRL, because ultimately management has to confirm. That is okay, but I'm saying I want to the extent is saying that you sign anything, management has to first give you representation letter. I'm in that context I'm saying. So because limited review, whenever it is whatever it is signed, ultimately it is the management's responsibility. If there is something which has happened post that, how do you know? But what I'm saying is we tend to not take it, and when to take it when the peer review is there, or you feel realize NAFRA is going to knock the door. That's that time one runs around. But actually, it's an unlimited liability which one takes if management representation is not taken. Archival, right? I need not say more, but it is 60 days, whichever way one needs to do, digital or physical. But the policy, it's SQC1 says 60 days, and the whole process around, because now the records needs to be kept for 10 years from the date of signing, or longer period if required. So how do you archive those whole process around? So SQC1 is, when we do go and do the audit, we say what is the SOP of the company, right? So SQC1 is the SOP, which has been there right from 2009. This SQC1 is what is the SOP of audit control, audit quality, and these are there are some elements of this SOP is which we'll discuss. And that is exactly what an in around. So what are the policies and procedures? So when you say that आपका P2P क्या process है और OTC क्या process है, so as a peer reviewer you have to ask कि आपका ये सब process क्या है? How do you what is the who is responsible for audit quality? It says managing partner is responsible. Where is it written? Correct. Idea is that ultimately when we go as audit, it is the SOP what we look at or we document. But now the standard is very clear that it is not a documentation, it is the SOP, the firm should have that SOP of SQC1. That's so, and I've seen a lot of firms don't have this SQC1 SOP. It's a SOP. उसको बोलो. So those elements of this, it becomes very difficult to demonstrate. But what I'm saying is this is uh, yeah. So as I said, it is effective from accounting period 2009. And then how this SOP is implemented on the engagement. So which is in SA 220, which is effective from April 1, 2010. I'm just giving, combining the two. The idea, overall objective of the SOP is that the firm and the personnel comply with professional standards, regulatory and legal requirements. And the most important is the reports issued by the engagement partners are appropriate in the circumstances. It's not true and fair, sab barabar hai to barabar hai. Qualification is also fine. Idea is that is it appropriate under the circumstances? Just think about it. If you read any audit report of auditor who feel that uh, 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 that that person does not comply or the firm does not comply with the professional standards, regulatory requirement, and you can't rely on the report, the value of that financial statements which you are reviewing, correct, you will not rely on that financial statements. The idea is that how to improve the audit quality. So that is, this is the objective of this SOP, if I were to use the word. And what are the components of SOP when we say O2C, P2P, manufacturing, in whatever? So leadership responsibilities. Who has the leadership? What are the requirements of ethical requirements? Means ethical requirements. So ethically, how would you are expecting your people to behave? How do you the firm accepts and continues the client? Very normal thing which everybody is doing, but it's not documented. How the human resource policy around, how the engagement is executed and all this, what we saw in this, and how it is monitored. I'll just run past the key areas and cube my points down. The idea is that first is responsibility should be of the managing partner. It can be delegated to somebody, but it has to be, overall should management partner. Why managing partner? Because audit quality and commercial considerations may not go hand in hand, may not go. Correct. So if it is only commercial consideration, a managing partner will ensure commercial consideration. But when it comes to quality, management partner may override, and hence the idea is that to have audit quality should be the responsibility of the managing partner, because there is a resources which will be required. It's, there is a time, money, resources which is there, and more importantly, the performance evaluation, because performance evaluation is normally done based on who gets more business, right? But here it is not who gets more business, it is who does better audit. And if in the file which is reviewed, if the quality is not good, and if that partner or that team has been rewarded because of getting new business, as a peer reviewer or somebody will come and question that you don't believe in audit quality. So that is where the overall responsibility is of the managing partner for the audit quality. So this is one. Second is on the ethical requirement. It is given. One can't demonstrate, but I'm saying this is the guidance that integrity, objectivity. One has to be objective in, one should not get biased by what is the client's view and then we'll go by that view. What is objectively, because our opinion is relied on by all the stakeholders, and objective evaluation is important. Professional care, competence, we are competent, reliable, communication, how we speak, we are committed, right? These are all, it can't be demonstrated, but this has to be reinforced. Confidentiality, very important. No discussion uh, about clients with anybody. And I would say from one engagement team to another engagement team, because each client's work is confidential. No client likes its works to get discussed by others. One can generalize something, but otherwise the confidentiality within the firm, outside the firm is very, very important and critical. And the last but not the least is independence. Some the discussion around independence uh, is the familiarity threat. So SQC one says partner needs to be rotated after 7 years. But how one ensures that other senior team members are also rotated in 7 years? Because that is important. Lot of familiarity. That means ये client last time बोला था ये professional skepticism. One tends to avoid or not follow do this professional skepticism in that case. Um, Self-review threat, intimidation. Lot of times you you would have seen client complaint karega. So key client, if somebody is asking too many questions, client will complain, isko team change karo, ye partner change karo. That is intimidation threat, and that can impair the independence. It's very clearly given in SQC1. So if that is the case, one has to evaluate whether I should continue this client or not. The client will, so client will take the work to another auditor, and you'll be asked NOC. It is your option what you want to write in the NOC, right? It's very normal. So I'm saying that is how the standard has been there. So one has to then give it. Now NOC has become very important. The whole process of, say, now the 5 years, at least for listed those companies, 5 years, the appointment is there. Within 5 years, then it's a resignation. Why you've resigned? File those documents. So it is so regulators have also tried to tighten those leakages. So resignation has become, and the client also realizes that I have to bear this firm at least for 5 years, if not for 10. And conflict of interest. Um, Independence is so very important, and for the regulators, large firms, the independence, how do we ensure, because the firms are becoming larger. So how do the whole process around who is responsible for independence? How do I know if I want to buy shares of any company or have business relationship the firm has? So how the list is available, right? So I can't buy shares of these companies. So how do how does, who is responsible, and how this process? I'm saying this is a SOP which will be there. Secondly, if firm wants to provide any other services, then how, what can be provided, what cannot be provided. So whole guidance in and around independence, which is important. But last not the controversial is shares. If your financial interest, and somebody were to come, I'll have to audit this. Who ensures this? Because firm will give a policy. So a lot of firms have the process of auditing the financial holdings. So one does not hold this financial securities in a prohibited company or proscribed companies. But evidence of this is it gets audited. And I have not seen it is being followed in many firms, but idea is a kal would get some independence, because that is something which all the regulators are talking about is about the independence, and this is actually the hot topic for larger firms, bigger companies, what to do if such scenario happens. But idea is that this SOP will be based on the kind of clients which the firm has. Uh, Client acceptance. I think this is a lot of this material is there in the standard, but when the client comes, and I'm aware of few of the instances, and hence I'm sharing. The client comes, lot of firms they don't ask for formal NOC, and the formal NOC doesn't, so similar to your case, and I know at least one of them who has gone into litigation because that person also, the new auditor also realized that what problem was there, and when he approached the old auditor, he said, "You never came to me for the NOC. You're very happy accepting this client," and the client was a sweet talker. So the first one did not do anything. The second one, something happened, and the client has gone into taken the new auditor to court. So the idea is that this NOC, please ensure that there is a NOC which is being taken the client, because you don't want to get into wrong clients. And what kind of work and diligence which is being done to accept this client is the one which one has to document. What kind of background check, what kind of KMPs are there, what is their market reputation. Just evaluate some kind of process, because getting new work is, everybody likes it and would justify that why I want this client. But objectivity in this evaluation is important. It also says the client is paying less fees, you can refuse the client. Client is constantly asking for less fees. Client is it is all SQC1, it is giving guidance. If client is constantly saying that why you need this information, why you are asking this, correct, please evaluate whether you want to continue this client. If client is complaining about the team, please evaluate whether you want to continue the client, because it's a pressurizing tactics which the client and you would have experienced a lot of clients ask so many questions about sharing of information. One more important thing is evaluating whether the firm has a capability and competency to accept the client and the engagement. Lot of new work is available. Evaluation whether I'm competent to do it, correct, and whether I have capacity, experienced people to execute, because the risk, all this is associated with the engagement. One has to evaluate. Then human resource. I'm just talking about SOPs. It is talking about what kind of SOPs. So it says right from the estimation of what is the requirement. How do you estimate what kind of competency and capabilities which are required? How do you recruit? All the recruitment. How do performance evaluation? How the compensation is being done. NAFRA comes, NAFRA will look at the office policies, SQC1. So compensation policies, how the promotions are being made. And finally, how do you guide the career development? But NAFRA will focus mainly on those partners as a policy, and then look at those files where how those are evaluated. Because it's like how, how now SQC1 is like, first you understand what is the office policy and procedure. So you look at, this is SQC1, 15 years old. So they will have a lesser here. As I said, SOP also for a complicated businesses or larger companies, it will be more detailed. Here it will be simple. But That is, so you have to decide whether you want what rating you want to give. हाँ, 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 बराबर है. Correct, correct. But it has to be there. What I'm saying is, it cannot be, as I said, if they're getting, so because peer reviewer is a different, but if NAFRA comes and reviews, and there if one says कि file नहीं है, but I'm a peer reviewed firm with highest rating, क्या होगा? So this is human resources. The whole performance, I think a lot of things we have said. One thing is on planning. I'm not sure whether I mentioned, but in my experience, 30 to 40% of the time goes into planning. Well planned is half done. It's always said. Plan, 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 do plan. Then it's very easy to do because when the peak time comes, that time, all the issues are settled, and the audit gets closed efficiently unless something comes afterwards. As I said, it has to be, you know, our responsibility. Everything changes till the time we sign off. But well planned is half done. So you will have correct. So that is, see, idea is that look at the kind of engagement which is there. Correct. Regulated, simple, complicated. Simple engagement, it is easier, but more and more complicated. And if you get into NAFRA engagements, so one has to evaluate and take a call according. Review, supervise, I think this also we have mentioned. How it is reviewed, supervise, what are the documents, time. Ultimately, time sheet will speak for everything. Consultation, I think we have mentioned that what is the firm policy for consultation, right? And how, so, a lot of times one would say that if there is a going concern, then have some consultation, how to give reporting. If there is some non-standard report, please consult. Correct, because there is, one is not missing out on. If it is any complicated accounting, please consult. If there is some challenge in the auditing, please consult. So the idea is that if there is a process which is there, what is defined, then whether that has been followed or not. So one is something is which is coming from the standard, something is which is from a firm perspective, it can say. So I can draw one EQCR responsibilities for the listed companies. EQCR is there, but lot of firms are now going concern. Why can't we do it? If there is something which are averaged, why shouldn't we do it? Because the risk idea is that if the risk increases, the firm may have a different policy. So one is the bare minimum which should be there in the SOP, but if it is more, the firm will decide. This is a SOP. Think about it as when we go to audit. What is the SOP? And depending on SOP, whether it has been followed or not, if it is a design effective, correct, or operating effectiveness, correct. So whether design is right, then SOP is right. Whether it is implementation issue, it is exactly the same way. SQC1 needs to be done. I'm almost done. EQCR, as I said, this is the hot topic. Uh, Difference of opinion between consult, and EQCR, how needs to be dealt with, and archive. Last but not the least, think about it again. SOP implementation. We also have internal audit, right? for clients. Monitoring is like how it is the firm ensures that whatever policies, procedures relating to audit quality is there. How the firm is monitoring. Yeah, I have all the process. The company has all the SOPs. It has been implemented. But who comes and audits? It could be internal, it could be external. And what is the record of monitoring? That okay, what has been done? Is it a design? So something which is pervasive. Somebody, some so all clients, there is a challenge. That means it's a design issue or operate effective implementation issue because it is there in one of clients. And how do you deal with these learnings from this and then communicate the fresh update to the team to ensure that the audit quality uh, is remains high. So that's it for the monitoring. So it could be, as I said, who has in sole proprietor who comes and reviews the file is also important. So that is it from my side. So thank you. I was given 1:15 as the time, so I